We're going to be talking today about two things. We've got back-to-back sessions scheduled. So the first session, we're going to be focusing on key concepts to know when buying options, and we're going to spend a little time comparing long options, long calls, specifically to buying stock. And then the second session, the other side of the coin, that's going to be key concepts to know when selling options. Very briefly, this is a standard options disclaimer stating options have risks. Those risks are outlined and defined in a document called the Characteristics and Risks of Standardized Options. You can get a copy of that to download on our website, optionseducation.org, or you can contact your broker for a hard copy. During my presentation, you're going to see some trademarks from the two companies that I represent, Options Clearing Corporation, or OCC as we're better known as, and OIC, the Options Industry Council. OIC, for those of you that are unfamiliar with us, we are a free organization where we offer content specifically designed from a perspective of education. We are not financial advisors, therefore we don't make recommendations or provide advice of any kind. Rather, we simply exist for investors to have a trusted source of options information, and hopefully with that information, they can decide whether or not options are right for you as an investor. We do most of our work through our website, optionseducation.org, where we offer a host of online courses, monthly podcast episodes that I host, as well as a twice-a-month webinar program. We also have the pride and joy of OIC, which is our investor education team. It's comprised of myself and three other individuals. Collectively, we've got about 120 years or so in the options industry, all former traders and floor brokers. And we do a lot of, we spend a lot of our day answering questions. So if you have a question regarding options, shoot us an email at options@theocc.com. And it's a great way for us to have a direct conversation with each other and get your option questions answered. Really briefly, I just want to touch on volume for this year as well as previous years. As you can see here, things have really exploded over the last, really over the last 10 years and specifically over the last 5, really since COVID. The reason I like to highlight this is twofold. Number one, it shows that OCC, our parent company, cleared north of 12 billion option contracts last year, which is a record. Average volume so far year to date is about 50 million option contracts per day. So every day there's 50 million contracts or more typically trading hands. But because there's so many more market participants, and a lot of them since COVID, since the pandemic, a lot of people are starting to get more into options. They're taking more control, more direct control over their finances. But that being said, that just proves, at least to me, that there's a greater need for education. People need to understand what they're getting themselves into. And trading options, it's a complex product, right? So it's not something as simple as stock, where you buy the stock and you put it in the drawer. Options require constant monitoring. They require you to be an active participant in investing. And because there are so many different nuances to various option strategies and option contracts, education is really important. People need to know what to expect and how to react if certain situations arise. So just one reason why we like to highlight this volume slide: more people are engaged in the product, and therefore more education is necessary. And part of that education is where we come in, the Options Industry Council. Today's presentation, as I mentioned, we're going to be talking about key concepts to know when buying stocks. So we're going to start out with talking about leverage and looking at an example stock versus options. We're also going to get into strike selection and moneyness and time decay. 3 things that when buying options, they affect the value of that contract and they impact the value of that contract. And then we're going to look at a simple example of buying calls. So let's go ahead and get into it. Leverage. When we are buying options, actually when we're trading options, whether we're buying or selling, I'd like to say that there's two questions that the investor needs to ask themselves. Number one, first and foremost, is what is my forecast? Where do I think that stock is going to go, or whatever that underlying asset may be, whether it's stock or an ETF or an index? Where do I think that's going to go? Is it going to go up? Is it going to go down? Is it going to stay the same? One of the beauties about the flexibility of options is that regardless of market movement, there are strategies out there designed to help you profit. So when you buy stock, obviously we want that stock to go up. If it goes down, that's not going to work out too well for us. With options, we can choose a strategy that allows us to benefit when the stock goes up. We can choose a strategy that allows us to benefit when the stock goes down, or we can choose a strategy that allows us to profit if the stock doesn't move any direction whatsoever. So these are just some of the differences, use cases of options versus stock, but we need to ask ourselves is, where do we think that stock is going to go, and how long is it going to take to get there? That's that second part. That's going to be that expiration date. So with a stock, you can buy it and hold on to it theoretically forever. But because an option is a contract, like all contracts, it has an expiration date. They're only good for a certain period of time. So we need to make sure that the option that we're looking to purchase or sell, for that matter, that we are choosing the appropriate time frame for two reasons. Number one, if we're investing for an earnings event, let's say that's coming up 3 weeks down the road, then it does us no good to trade an option that's going to be expiring 2 weeks from now, right? So we want to make sure that if there's an event that's going to occur, we want to make sure that that event occurs within that time horizon that our option offers us. The second reason that we want to know is because time is money. Just like with any other really thing in life, time is money. It's really prevalent when it comes to options. And simply because if I'm a seller of an option, I'm incurring a risk. And the longer I'm holding that risk, the more I have at stake. So I'm going to want to make sure as an option seller that I collect enough premium, right? That's what we call the price of the option, the premium. I want to make sure that I collect enough premium to cover that long-term risk that I have. So that means that longer-term options are going to be more expensive than shorter terms. So it's going to be kind of a trade-off. For example, if we're looking at that earnings example again, I want to make sure that the option I'm purchasing covers that period between now and that earnings event, but I don't want it to cover much more than that because I'm going to be paying for all of that extra time that I may not necessarily need or want. So we start with the forecast, we follow it with an expiration date, and then we select a strategy. If we're looking to buy options, are we looking to purchase calls? Are we looking to purchase puts? Are we maybe looking to buy a spread of some kind? And then we should also have in mind an exit strategy. There's a saying that we have on options, plan the trade and trade the plan. So not only is it important to know when to get into the position, but it is equally as important, and sometimes even more important, that we understand when to get out of that position. So these are just some of the questions that we ask ourselves that we really need to address for ourselves before we start plunking down our hard-earned money and investing with options. So the thing about leverage is it offers us what we call more bang for the buck. You can buy 100 shares of stock trading at $100 a share and invest $10,000. You can take that same $10,000 and invest it in options and generate significantly higher returns, or I should actually rephrase, you can potentially generate significantly higher returns simply because you're able to capitalize on the leverage that options offer. And here's an example. Here's a scenario that we can look at. Due to recent events, Lindsay is extremely bullish on pharmaceutical stocks. To speculate on the industry as a whole, she's found an ETF that groups several of these companies together. Stock's currently trading $50 a share, and she can buy 100 shares of stock and invest $5,000 by buying that stock. Or she can buy a $50 strike call for a 6-month period at $4.50 per option. Okay, so for that same $450, she can control 100 shares of stock at $50 a share. So it's a significantly lower capital requirement trading with options than trading with stock if we're just going one-to-one. And let's see what might happen here if this is the plan that we do. Rather than just buying that one option for $450, Lindsay's going to go ahead and purchase 11 of these. So rather than investing $5,000 in stock, she's going to invest roughly $5,000 in options. And here's what things look like. If we just take that $50 stock price and stock doesn't move at all, at the end of that 6 months, her 100 shares of stock are still going to be worth $50 a share or $5,000. So there's not going to be any gain, any loss in her portfolio. She's going to see everything relatively flat. The thing about buying options, though, is that we need something to happen. There's a concept called time decay. And what time decay basically tells us is that with each passing day, our contract is going to be worth less. You can think of options as a decaying asset. As each day passes, that option is going to be worth less than it was the day before, assuming all other factors remaining constant. So if that stock doesn't move, her stock portfolio isn't going to change. That's not going to be a problem. But we need that movement as option buyers in order to gain that value. So if things don't change from day 1 to day 180 when that 6-month contract expires, we're going to lose that entire option investment. We're going to lose all $4,950 that we invested. So that's going to be 100% loss. One of the risks with options, right? Obviously, there's no reward without risk. And as we have an elevated potential for reward investing with options, there also hand in hand is going to be that elevated risk. So if things don't operate as we expect them to, remember, we're starting with a forecast. If our forecast is wrong and that stock isn't increasing, that's going to cost us money. Now, if conversely, things do go our way, let's say we were bullish, we thought there was a lot of room, the stock was $50, now it's trading $60. So we made $10 per share. In our stock account, we had 100 shares, so that's a $1,000 profit off of our, $1,000 profit off of our $5,000 investment. So that's going to be a 20% gain in that stock portfolio over 6 months. Not too bad. I think most people would be pretty happy with that scenario. By going with options instead, we've got a 120% gain because now that option, that $50 option that we paid, $4.50, it's now worth $10. So we've got that significant increase in value. And because we bought so many of those options, that same $5,000 with stock, it's now worth a $6,000 position. With our options, it's now a $6,050 position. But the difference is we only invested $450 versus the $5,000 with the stock. So that's kind of how leverage works. It gives us a potential for some tremendous upside gains. But again, the downside to that, the balance to that reward is going to be that risk. If stock doesn't perform as we want, if it doesn't move upwards from 50 like we need it to, if it stays stagnant, or worse yet, it even drops, we're going to lose 100% of our investment. So that $4,950 that we invested rather than the stock, those the funds are gone from our option. So it's almost like a double-edged sword, as people refer to. So leverage can work out great, terrific returns if things behave the way that you're expecting them to and you're forecasting. The downside to it is that obviously you have increased risk as well. Strike selection and moneyness. These are all things that go into the value of the option contract. Options pricing has two components. We've got intrinsic value, which is the inherent value of the option, and extrinsic value, which is everything outside of that. One of the ways I like to explain it, coming from Chicago, I like to say that, let's say you had a $10 bill. Inherently, that $10 bill is worth $10. What if we got Michael Jordan to sign that $10 bill? Again, being from Chicago, he's a Chicago icon. An autograph, Michael Jordan's autograph on that $10 bill is going to be worth something more than $10. So the bill itself, that's going to be the intrinsic value. It's inherently worth $10. Michael Jordan's signature, that's going to be the extrinsic. If I could sell that $10 bill for, and hypothetically, I don't even know what Michael Jordan's signature is worth, but let's say it's worth $10. If I could sell that $10 bill for $20, I've got $10 of intrinsic value and $10 of extrinsic value, right? Is that clear? The intrinsic value is going to be the difference between the stock price and my strike price of my option. And let's say we're talking calls. If I had a $50 call, it gives me the right to buy those shares at $50 per share. If stock is trading 60, now my right is intrinsically worth $10. So that's intrinsic value, difference between my stock price and my strike price. Extrinsic value is going to be everything else. And by everything else, I mean days until expiration. I mean the implied volatility level, whether or not there's any dividends attached to the option, interest rates, right? Those are all going to be pricing inputs extraneous of the stock price and the strike price, but those extraneous inputs still impact and create the value in that option. And we call it time value because one of the ways I like to explain it is that you are purchasing time for something to happen. If I'm buying a $50 call, and let's say stock is $45 in the market, I'm buying a $50 call. It's what we call out of the money because there is no inherent value to it. There is no intrinsic value. Then in order for me to profit, I need that stock price to go above $50. In that time that it takes for that to happen, or the possibility, the opportunity for that to happen, that's what I'm actually paying for. That's all of that time value. That extra money that I'm plunking down outside of intrinsic value is the extra time that I'm purchasing for my forecast to come to fruition. And hopefully it will. Because at expiration, options are only worth their intrinsic value. They have no extrinsic value whatsoever. All time value disappears at expiration. In the money options have intrinsic value only. They may also have that time value that we were talking about, but at the money and out of the money options only have that extrinsic value. There is no intrinsic or inherent value to them. So when we look at call options, the difference between in the money, at the money, and out of the money, the chart on the right, and again, if you want copies of these slides, drop us an email, options@theocc.com, and we'll be happy to get you a copy of the entire deck. But call options, it's a little easier to understand pretty much anytime you're talking about options. Call options are maybe a little bit more intuitive for people, but when we talk about in the money for a call option, it means that our strike price is lower than our stock price. At the money, whether it's going to be a call or put, that is where our strike price equals our stock price, or at least is fairly close to it. Out of the money is where our strike price is above our stock price. That's where we really need for things to happen to our option in order to realize some profits. We need for that stock price to move, or any of those pricing inputs that we had talked about, implied volatility specifically. We need those to move or cooperate with us in order for us to generate profits on our trade. Put options are going to be the opposite. The put option, when we're buying it, it gives us the right to sell stock at that strike price. So for my put option to have inherent or intrinsic value, the strike price has to be above where the stock is trading. If I've got a right to sell that stock at $75 because I bought that put, in order for that to have any inherent or intrinsic value, that stock price needs to be below 75, right? So that's where it becomes in the money, where my strike price is above my stock price. Out of the money is going to be where my strike price is below the stock price. One key point that I want to talk about is in the money, at the money, out of the money has nothing to do with profit. In the money, the definition is that the option has at least 1 cent worth of value. So if I had a $50 call option and stock closes at $50 and a penny, my option is technically in the money because it has inherent value. It's got 1 cent worth of intrinsic value. Now, if I paid $1 for that option, even though my call option is finishing in the money, I'm still going to lose 99 cents on the trade, right? I paid $1 for it and it's worth a penny. I'm going to lose 99 cents. So moneyness does not equal profit, something that I want to make sure that everybody understands. In the money options are more expensive than at the money or out of the money, which makes sense, right? If I've got the right to buy stock at 45 and it's trading 50, that option is going to be worth $5 at least, versus my right to buy the stock at $55 because I've got an out of the money option and stock is trading 50, which is going to have greater value. Obviously, the in the money because it's got that immediate intrinsic inherent value. In the money options also offer a more favorable break-even point, which we'll look at in just a moment. And they also have that greater likelihood of the stock finishing in the money. If it's in the money now, there's a greater likelihood of it remaining in the money than than an option that is currently out of the money. Stock is trading $50. It's likely that my $45 call is going to remain in the money. There's a higher probability of that versus my $55 call, which is out of the money. I need that stock to rally at least 10% in order for that out of the money call to have any intrinsic value. Whereas my in the money call, it's already in the money. Stock can drop 10% and I'm still in the money, just barely, but stock can drop roughly 10%. So the movement of that stock with an in the money option is not necessarily as important as it is for an at the money or an out of the money. Out of the money strikes, therefore, are less expensive. They also have less favorable break-even points, and they have a lower likelihood of finishing at expiration with any intrinsic value. And let's break this down. This might put things in a little bit more clear of a perspective. Here's a scenario. We've got a stock trading $75, 45 days to expiration, 30% implied volatility, right? So these are some of the pricing inputs. We know what the stock price is. We know how long of a duration or days till expiration. DTE is a phrase I'm sure most of you are familiar with. So we know the stock price. We know our DTE. We've got our implied volatility. The only thing that we're really missing in order to price this option is the strike price and then dividends and interest rates, if any. And dividends and interest rates, we usually kind of leave those out of the equation when we're educating because they're not as much of a factor normally. But let's look at a difference in strike prices here. So stock is trading $75. The at the money, right, the 75 strike call, you can see here is trading for $3.15. Let's see if this works here. So $3.15. I'm not sure if anyone can see that. The first column, $75 call, $3.15. Our break-even point is $78.15. That means that we need that stock to go beyond, at expiration, we need that stock to go beyond $78.15 in order for us to profit. So the break-even calculation with a long call is simply your strike price plus the premium that you pay. So the at-the-money call, $75 strike, $3.15 premium, our break-even is $78.15. That $3.15, when you buy options, the most that you can lose is what you're putting into it. So that $3.15, not only is that the premium that we're paying, but that's also going to be our maximum loss potential. We cannot lose more than that. And as each option typically controls an interest of 100 shares of stock, we've got a standard multiplier of 100. So $315 becomes $315. We cannot lose more than $315 if we buy that $75 strike price. All right? As we're moving up and down the option chain, let's look at out of the money. Let's go to the $85 strike. So that's going to be at the bottom left of your screen there. That's trading for just under half a buck, so 48 cents. That's going to be if we bought that, that's going to be our maximum loss, 48 cents per option contract or $48, right? So with the at the money, we can lose 315. The out of the money, we can lose 48. Now, the trade-off seems kind of simple, right? Which one would you rather have? I'd rather have $48 at risk than $315 at risk. That kind of makes sense. But that's only one side of the equation. The other side is, let's look at our break-even point. With our at the money, our break-even point is $78.15. Let's just call it $78 even. We need stock to move beyond that point in order to profit. With our out of the money 85 strike call, we need stock to go beyond roughly $85.50. So we need that stock to make a significantly higher move by going with an out of the money option than we do with an at the money. So sure, we may be risking less of our dollars, but we also have a lower probability of turning a profit on this. You know, which is more profitable? The stock going to 78, not profitable. Which is more probable? The stock going from 75 to 78 and change, or from 75 to 85 and change. Obviously, that lower strike, that lower break-even point is going to be more easily attained, and therefore you're going to have a higher probability of hopefully turning a potential profit. So the further out of the money we go, the less premium we're collecting, the less risk that we have, but also the less likelihood or the lower probability that that contract is going to turn profitable. Go down to in the money. This is where things get interesting. $65 strike, right? So now we're $10 in the money. The $85 strike was $10 out of the money. So we're kind of equidistant. The $65 strike is trading a little over $10. So we've got over $1,000 of risk if we buy that option and things don't turn out the way that we want. Got over $1,000 worth of risk. But look at that break-even point, $75.30. Stock is trading 75 in the market. So we really don't need a lot of movement in that stock price in order to turn a profit on that trade. We only need it to go up, 30 cents and change, something like that, in order to start profiting on this trade. Whereas with the out of the money, we need that stock to rally more than $10. So it's a significant increase. So, in the money, at the money, out of the money, they all have their benefits. They all have their, there are pros and cons to everything. And just like with options trading, there's always going to be a balance, risk versus reward. But, these are things that you'll keep in mind when choosing a strike. You'll want to look at what that break-even point is going to be, what that risk situation is going to look like for me. Delta is another thing that some people concern themselves with. Delta is going to be the option's sensitivity to those changes in the stock price. Some people equate delta to the speed of the option, how quickly that option value is going to move as the stock price moves. So these are all things that when you're buying options, you're going to want to ask yourself, again, what's my forecast? Where do I think the market is going to go? And how long is it going to take to get there? What is my objective? Am I looking for leverage? Am I looking for speculation? And then what am I looking for in terms of risk, reward, break-even points, et cetera? That's all going to come from those strike prices. So these are all questions that you're going to be asking yourself and hopefully providing some fairly accurate answers before purchasing options. All right. Duration, DTE, days to expiration. When I started in the business back in 97, there was basically monthly options. All right. So they expired the third Friday of the month. That was it. There were also, maybe end of quarter, end of year options, but really monthly options was the biggest thing. And expiration week was the biggest event of the month. As a broker, that's when that week is when I did the most business for the month. I typically did about half of my business for the month in just that week. And expiration was actually so important that was one of the weeks that you were absolutely forbidden to take vacation time. I remember I had to schedule my wedding around expiration week. But with the exchanges, once they went public and for profit, and they started being more responsive to customer demand, right? Just like any other business, they respond to demand. So the exchanges responded to the demand of the customer, saying, we want more flexibility. We want to be able to tailor our trading a little closer to specific events, an earnings release, a drug trial result, a federal election, right? We wanted to have more flexibility with our contracts in terms of longevity outside of, once a month. So they created weeklies. They also created something called LEAPs, which are long-term equity anticipation securities. Really, LEAPs are just long-term options. They behave like any other option pretty much. But now we've got all of these different expirations to choose from. And again, we want to be cognizant of that time is money, because the further we go out in time, the more we're going to be paying for it. So if we had a $50 strike, the LEAPS option, going out a year or more, is going to have the largest premium attached to it. The monthly option would be a little bit less, right? Let's say we're going 30 days or 6 months. That's going to be even lower. And then weekly options, lower yet. Zero DTE, one of the buzzwords that's in the trading zeitgeist right now. Obviously, those are going to be the cheapest options because they've got the shortest time frame. But we want to remember, it's not only the direction that we're picking, we're also picking the magnitude of that move, right? It's not really enough as an options investor, unless you're a speculator, to simply say, I think the stock is going to go up. Yeah, that could work. That might work out terrific for you. It would be better, or a more accurate forecast might be, I think the stock is going to go up 5%, or I think the stock's going to go up 10%, and maybe it's going to take 3 months to get there. The more you can fine tune your forecast, your objective, et cetera, the more you're able to zero in on what specific strike you want, how much premium you're willing to pay, how much risk you're willing to take out, because the last thing that we want to do is buy more time than necessary. I don't want to buy 6 months worth of option premium for an event that I'm trading around that's going to happen in 3 months. So we're never going to want to buy more time than there actually is. Theta, or time decay, I was mentioning days till expiration is one of those pricing factors. Theta and time decay are concepts that tells us that with each passing day, I mentioned an option is a decaying asset. Each passing day, that option is going to be worth less money. Now, you can see by the graph here, when we start out at the genesis of that option contract, and let's take a LEAPS option, right? Let's say we're looking at an option expiring a year and a half down the road. Well, with each passing day, from a year and a half out, you're not going to see that much change in the value of your option from a time perspective. Because instead of, a year and a half is, about 550 days, roughly, something like that. Day 550, the option's worth X. Day 549, it's not going to be worth that, there's not going to be that much of a difference one day when you still have so many days to go. But it's when we approach expiration, that's when you really see that time decay accelerate. Time decay is exponential. On expiration, remember, the option is either worth its intrinsic value or it's worthless. It's a binary event. It's either worth something or it's worth nothing. So all of that time value, all of that extrinsic value in the option is going to get sucked out of that contract that last day of trading. So if you've got the last day of trading and the option is, still out of the money and it's worth a quarter, At the end of the day, it's going to be worth zero unless that stock makes the right move to put that out of the money option in the money. So you're going to lose all of that time value at the end of the day. These are things that are working against the option buyer. Time decay is working against you. And each and every day, you're going to lose a little bit of value of that option, which is why it's necessary for those things to happen, like the stock price increasing, assuming we're talking about long call options. That's why we need that stock price to move to offset the guaranteed loss of value that we have with time decay. We need implied volatility levels to increase in order to offset the guaranteed loss of value that we're going to experience with time decay. And those are the reasons that we're purchasing that time value, that extrinsic value in the option. We're buying that time for something to happen because something needs to happen in order for us to profit, all right? And if it doesn't, that's where that time decay is going to erode all of the value of our contract until on expiration, there is nothing left, no value, and we lose whatever premium that we had paid into it. And here are two different examples of how time decay works, both with a lower volatility option and a higher. So theta, that's going to be the amount of the option's premium that decays per day, as I'd mentioned. On the left side of our screen, we've got a typical option $50 at the money call, trading with a 20% implied volatility level. And we're going to juxtapose that with the at the money option with a 40% implied volatility. So with a year out, this at the money call on a $50 strike, with a year out, it's worth about $4, $3.98. And you could see that theta, it's less than half a penny, right? So that time decay really isn't doing that much for us or against us because we're buyers. When we talk about time decay, the phrase I like to use is that time decay is a friend to option sellers and it's a foe to option buyers, right? Just something to keep in mind. So a year out, this option is worth about $4 at a 20% implied volatility. With 5 days left, so now we fast forward throughout almost the entire year, and assuming that stock price is still $50, assuming the stock hasn't moved, assuming implied volatility is still trading around roughly 20%, and certainly the stock can be moving, implied volatility can be moving all throughout that year, but with this snapshot, we're just assuming that 360 days after we first put on that trade, we're back to where we began. Implied volatility is at the initial level, stock price at the initial level. And look at the value of our option. It went from almost $4 down to below 50 cents. So we lost a significant amount of that option premium because the market didn't do anything, because it didn't cooperate and provide us the changes that we needed to offset that time decay. So whereas theta, when we first put that trade on, was decaying the option less than half a penny a day, look at 10 days out, right? We got about a week and a half to go. Now it's about 3.5 cents per day that we're losing. 5 days, less than a week before the contract expires, we're losing almost a nickel a day in time decay. So that time decay is going to continue working against us. We need for good things to happen to offset that. When we change the volatility, right, now we've got an even more volatile stock. The market is expecting the future volatility of this stock that we're investing in to be more significant than it had been in the past. Implied volatility increases. Well, a year out, look, our option is trading almost $8. One of the reasons that I like to highlight this is earnings season. A lot of us might look to trade or look at earnings season as an opportunity for potential profit. Other people look at earnings season as an opportunity for tremendous risk, and they stay out of it altogether. I know a lot of option veterans that have been in the business 30 some years, and they swear that they will never invest around earnings season simply due to all of that uncertainty, right? It's an unknown event. And sure, you've got expectations, what might happen, but what might happen and what actually happens can be two very, very different things. So earnings season can be a terrific opportunity for potential profits. It also can be a horrible opportunity for prospective losses. Sorry, lost my word there. But the reason I wanted to show you this, to look at these two scenarios, is let's say, and let's look 30 days out. 30 days out, our at-the-money 20% vol call is trading for $1.14. That's the value of it. And that might be the value of that option, kind of throughout the year with 30 days until expiration. But now an earnings event comes in. And now that option that's normally trading $1.14 or so, give or take, is now trading twice that, right? It's now trading for about $2.28. The reason that I'm highlighting this is because, again, it kind of goes back to the timing of your purchase when buying options, that things can be more expensive. It's almost like eggs right now. A couple of years ago, we could get eggs for, a couple bucks a dozen, and now we're paying, 3 times that or more. So it all depends on when you're looking to get into some type of thing. If you're looking to get into an option around earnings season, that increase in demand is going to drive up option prices. Just like, with eggs right now, we're having not only an increase in demand, but it's being paired with a decrease in supply. So that's why we're seeing, the egg Armageddon or the egg apocalypse that we are currently. But the idea is that with earnings season, a lot of people see that as opportunity, and they start expressing that opportunity by buying options. And by doing so, that's going to drive up the option prices. So you can see here, with a higher implied volatility, that option is going to be significantly more expensive. Now, depending on when you get into that trade, you might be getting into it when it's still trading in the dollar range versus getting into it later and maybe more towards that earnings event when it's trading in the $2 range. So timing is certainly critical, something to keep in mind. But again, going back to the not buying more time than you want, once that unknown event becomes known, once those earnings numbers are released, that earnings report is released, there's a chance, and some people say there's a high probability or likelihood that that implied volatility level is going to come back down to its previous levels. And one of the things about implied volatility is that it's positively correlated with the options market. So with the call option or with the put, when you're buying options, if implied volatility increases, and it, kind of the same thing, if you're buying an apple and more people want apples, well, the price of those apples are going to go up, right? It's just kind of, economics 101. So if you're getting into that contract ahead of earnings, typically prices might increase because of that run up in implied volatility. But once the unknown becomes known, then it's expected, or there's certainly a potential for that volatility to come back down and those options becoming cheaper. So if you're buying options and you get in maybe right before that earnings event, and let's say you just arbitrarily, let's say the option costs $3, and you get in the week before earnings are released, maybe not much happens to the stock price or future direction that the company puts out there. But now the unknown is known, and now that $3 option is trading for $2, right? Nothing really happened with the market except implied volatility came back down to its normal levels. So again, just something about timing, not buying more time than you need, because now if you've got the option for another 6 months, you certainly saw a decrease in that value. You've got more time for good things to happen again. Remember, that's why we purchased all that time to begin with, but just something keeping in mind when, looking at certain events and when you're looking to purchase options, be cognizant of those corporate actions that are on the horizon, because that should certainly factor into your decision. Buying call options, I think I'm running out of time here. Buying call options, let's kind of go through this a little quickly. We talked about buying a call that you're bullish. You want that stock price to go up. You're looking for to benefit from those increasing share prices, but with a smaller cash outlay. Rather than buying 100 shares of stock, now you're buying an option to control those 100 shares of stock. You're looking for leverage, possibly. You're looking for speculation. These are all reasons why somebody might buy a call option. And here's an example. We've got a stock trading $60. 100 shares of that would be a $6,000 investment. We're bullish on the stock. We want limited downside risk. Remember, anytime we buy options, we can't lose more than what we put into it. So we're buying a 3-month $60 strike call for $3. That's going to be our premium. Controls 100 shares. It's going to be $300 in the real world. That's going to be our maximum risk. So no matter what happens, the stock can go down to zero. We can't lose more than $300. If stock stays where it is at $60, we are still going to lose that $300 because remember, we need something to happen to bring those share prices up or the implied volatility up. If we paid $3 for that 60 strike call, we've got a break-even point of 63. So anything above 63, we're going to be profitable. Anything below 63, we may give back some of that $3 that we had paid initially. But if we're below our strike price, our $60 strike price or below, we're going to lose that entire premium that we paid. Graphically, here's what this looks like. Some people learn better with words. Other people learn better with illustrations. So graphically, here's our profit and loss chart. You could see our maximum loss is going to be the $300. That occurs when the stock price is $60 exactly or any point below. That's where we're going to lose all of our investment. Our break-even point, strike price, plus the premium that we pay. $60 strike price, $3 premium gives us a $63 break-even point. And you can see that's where the line, the vertical line, pardon me, crosses the horizontal stock price line. So anything over $63, that's where we're going to start taking in profits. But again, our maximum loss, we can't lose more than we put into it. Let's just go ahead now and kind of summarize what we had talked about. Option buyers can speculate on potential pricing movements on a stock or ETF. They typically do that with call options. The premium paid anytime we're buying. So whether we're buying a call or a put, whether we're buying a debit spread, buying a straddle, strangle, what have you, any option strategy that you have, if you are a net debit, meaning that you're paying more money than you're bringing in, it's a net debit, that is going to be our maximum loss. We cannot lose more than we put into that. And that net debit is going to be determined by, in part, our strike price. If we're looking for in-the-money options, those are going to be more expensive, so we're going to have to invest more in that option. We're going to have more risk in that option, but we're also, remember the balance of that, we're also going to have a potential of reward. We're going to have a higher probability of profiting. So that's going to be determined by our strike price. The more time that we're buying, the more it's going to cost. Longer term options cost significantly more than shorter term options. And that time is working against us as an option buyer. Remember, time decay, theta, that works as a friend to option sellers, a foe to option buyers. That's going to be it for our presentation. Here's a little bit more information about the Options Industry Council and our contact information. Optionseducation.org is our website. Options@theocc.com is our email address. We're on social media, YouTube, LinkedIn.